I did a little bit of research a few weeks ago showing that as the interest rates rise, over the past few years, ups and downs, you do tend to get the vendors stepping forward and looking to get on with their lives, offload their properties. Well, hi again, everybody. One of the big problems facing the potential buyers of property at the moment, and I guess this has been the case for quite some time, is quite a shortage of listings all around the country. On average, the number of properties listed for sale at the moment is sitting about 18% down from last year, and about 70% or so down from the number of listings back in about 10 years ago. Now, what's going to happen over the next few months is I think the listings are still going to remain in relatively short supply. Once Auckland opens up, I think there's some catch-up buying to be done there, and maybe in the rest of the country as well. Probably a little bit of hesitancy on the part of some of the buyers will evaporate and they'll finish their transactions as well. But I think we've just about reached the point where it's as bad as it's likely to get for the quantity of listings, and slowly over the next few months, maybe partly summer, but more especially I think once we get into autumn and winter next year, I think buyers can look forward to having a greater range of properties to choose from. Now, one of the key factors there is going to be interest rates going up. I did a little bit of research a few weeks ago showing that as the interest rates rise, over the past few years, ups and downs, you do tend to get the vendors stepping forward and looking to get on with their lives, offload their properties. And so we've got interest rates now which have gone up quite a bit in a short period of time. In fact, the popular 3-year fixed rate term at the moment, the interest rate on that is basically back to where it was in May 2019, just before the Reserve Bank cut interest rates 0.75%, and then of course they cut by another 0.75% in March of last year. Now, we're going to have, I think, as things rise, the interest rates rise, some of the people who've been quite fearful of selling and then not being able to buy again, they're going to decide, look, I'm just going to have to get on with my life. So there's going to be that factor coming through. Also, of course, for the investors losing their ability to deduct interest expense over time, I would expect some more of them to look to reduce their debt levels. And also with the increasing discussion about fairly soon the rate of growth in house price increases slowing down to a fairly strong degree, you're going to get people who are in there for a bit of a profit looking to take that profit, lock in their gains, and so bring their properties forward to the market as well. So look, in the very short term, I think the listings are still going to remain relatively tight out there. And when I look at the data, I can't yet see that the listings are going up. But the monthly survey I do with REINZ does show that for the past couple of months, there has definitely been an increase in the number of people going forward to a real estate agent asking for some appraisal of their property, I guess with a view to be selling it. Now, the other thing I just wanted to quickly mention, we have a large bank out there officially applying debt to income ratios, or a 6 basically, not going to lend to you if the debt is going to exceed 6 times your income. A couple of other banks have already been doing this on an informal basis for the past 2 to 4 months, and this is ahead of the Reserve Bank probably in the next few months officially instructing banks not to lend where debt will exceed, X times the people's incomes. The DTIs are interesting in that they are aimed at reducing the risk that as interest rates rise or somebody loses their job for a while, they won't be able to service their mortgage. LVRs, loan to value ratios, are aimed more at reducing the risk of somebody being in a negative equity situation. And the interesting point I wanted to make is this, that you can escape the LVRs by focusing on a new build. That is not the case with the DTIs. They're going to apply, it seems, to everybody out there. And I can't help but think maybe for some younger buyers trying to make a purchase in Auckland or Wellington, it might make an interesting little movement of some people down to our second largest city, which is Christchurch, where the median sales price is closer to $650,000 versus $860,000 in Wellington, and of course 1.2 million up in Auckland. But interesting to see how that one pans out over the next few months. All the best out there.